So when your credit score goes down, it negatively affects your access to credit, and it might in turn be costly for you to go out and get a mortgage. When the US government's credit score goes down, it also makes it more costly for you to go out and get a mortgage. Sounds fair, right? Yeah, I didn't think so either. We look at the recent US debt downgrade and its effects on you and the market in today's video. So stick around. So welcome back to the VIP Financial Education YouTube channel, folks. We help you go further, faster financially, something the government isn't exactly helping with, given the historic deduction to their credit rating. This recent and historic downgrade of US government debt has caused disruptions in the market, and it's added to the reasons for mortgage rates remaining near their highest levels in 25 years. Fitch Ratings reduced the US government's credit grade from AAA to AA+, and as a result, yields on 10-year Treasury notes surged to as high as 4.1%. And these 10-year Treasury yields significantly influence 30-year fixed-rate mortgages. The downgrade and subsequent rise in Treasury yields are concerning, as they are likely to result in slightly higher mortgage rates yet again. A recent Bankrate national survey of lenders found that the average rate on a 30-year mortgage reached 7.09%, approaching the peak of 7.12% observed back in 2022, and the highest rates since 2002. The steep increase in rates has impacted borrowers significantly, needless to say, making monthly payments considerably higher than when rates were at rock bottom levels during the pandemic. While economists have predicted a retreat in mortgage rates, the rating agency's downgrade poses an additional obstacle to this downward trend. Fitch pointed to concerns regarding partisan brinkmanship in Washington and the continuous political standoffs over the federal debt ceiling as the key reasons for the eroding confidence in fiscal management. Though the downgrade has raised mild concerns, it unfortunately does signal an impending crisis, and Fitch still considers the US government a very high credit risk. The downgrade serves as a wake-up call for Congress to address fiscal challenges and set aside their potential disputes. While the Federal Reserve doesn't directly control fixed-rate mortgages, its policy rate adjustments can influence the overall tone and therefore impact it. And as the Fed raised its policy rate from 0 to 5.5%, mortgage rates saw significant increases. For 30-year rates, the 10-year Treasury yield is the most relevant benchmark. An interesting phenomenon observed post-pandemic is the gap between 30-year mortgage rates and the 10-year yield, that it's widened significantly. This interval, known as the spread, usually ranges between 1.5 and 2 percentage points, but it's surpassed 3 percentage points currently, the highest level since 2009. And as a result, borrowers are paying around 7% for a 30-year loan instead of the expected rate based on the 10-year yield. While higher mortgage rates are expected for now, housing economists believe they could retreat to the low 6% range later in the year. This forecast relies on inflation continuing to cool down, prompting the Federal Reserve to pause on future rate hikes. Unfortunately, the US government's recent debt downgrade has become another obstacle for lower mortgage rates, so we'll keep our eyes on this as it progresses. Tell me what you think of the US debt downgrade. Do you think it was well-deserved or a bit too harsh? I do look forward to reading your comments down below on the situation. As always, don't forget to like and subscribe here to our channel, and obviously drop that thumbs up here for the video. Share it with anybody that you think could benefit from it. We're going to continue to help you go further, faster financially and get a grip on this crazy, volatile economic time in history that we are all currently living in. Till I see you on the next one, make it a great day today and keep on cash flowing.